Hello, and welcome to today's KraneShares webinar. KWEB's technical, fundamental, and manager positioning. Where do things stand? Hello, my name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. KraneShares maintains an extensive ecosystem of research partners who help us articulate our China views that we disseminate to our investors on a daily basis via ChinaLastNight.com and through periodic research available on KraneShares.com. I'm joined today with two special guests, Katie Stockton, the founder and managing partner of Fairlead Strategies, a technical and analysis research firm, and Stephen Holden, CEO of Copley Fund Research, which specializes in analyzing active mutual funds positioning from a stock, sector, and country level. Katie and Stephen recently both independently provided insights that we felt were just simply too good not to share with you as our clients. And as you can tell from my enthusiasm, I'm so excited to share two people we've known for many years, that we love their insights, we love their research, and we're happy to properly introduce you to two people that, for many of you that have the capabilities, should sign up for their research. But with that, let's just dive right in. Please proactively ask questions during the webinar, as we hope for a lively Q&A post-presentation. If you're viewing us on KraneShares.com, simply email us at info@KraneShares.com. Well, if you're joining us live, you can use the chat button. For those with CFP and SEMA, there will be continuing ed credits. Simply submit those that submission to CE Charlie Edward at KraneShares.com. And with that, let's dive right in. Very quickly, for those of you less familiar with KraneShares, our founder, Jonathan Crane, affirms two core beliefs during his experience living and building a successful business in China. Those two beliefs were the basis for founding KraneShares over 10 years ago. That first founding principle was that new China sectors such as domestic consumption, internet e-commerce, semiconductors, clean energy, and healthcare had become the new drivers of China's economic growth, and yet those sectors were underrepresented in global portfolios. The second founding principle was the opening of China's mainland equity markets, the second largest in the world, as well as China's fixed income market, which also is the second largest in the world, would have a significant effect on investors' portfolios in the years as those underlying markets were included in global indices. Most importantly, we endeavor to earn the trust of investors through our balanced perspective on China's economy and capital markets. As China's rise in market indices, along with the importance of its economy, will necessitate investors have a partner to navigate these developments. And KraneShares wants to earn that partnership role. We do so through our daily research blog, again, ChinaLastNight.com, which we encourage you to subscribe. Okay, so let's dive right in. I know many of you are familiar with our suite of not only China, but also climate, as well as our KFA platform. At this juncture, I want to hand things off to our good friend and research partner, Katie Stockton of Fairlead Strategies.
Thanks so much, Brendan. It's good to be with everyone today. I'm going to share my screen. So we have a slide deck to go through. For those of you who don't know me, I'm a technical analyst. And so that means I have sort of a unique perspective on markets, looking solely at price. We're just trying to understand not necessarily the companies or the countries that back up these securities, but the securities themselves and the supply and demand for them. So we're looking at price charts, we're looking at technical indicators, which are essentially mathematical gauges of things like momentum, overbought, oversold conditions, relative strength. We have been working for many years with KraneShares to help them understand the technical posture of their funds and investments. And we're really grateful for the partnership. We ourselves have an independent research provider. We also manage our own ETF called TAC, T-A-C-K, or the Fairlead Tactical Sector ETF. We provide technical analysis research to individuals and institutions, and it kind of runs the gamut, but tends to be more US equity centric. We recently added a weekly report called ETF Navigator, of which one of the KraneShares funds called KWEB, which is the focus of today's talk, is featured on a monthly basis from a technical perspective. And I think now is a really good time to be having a conversation about China from a technical perspective, in that there's some exciting developments on the charts that suggest that a long-term bottom may be underway. So let's go ahead and proceed here with the charts. First, we're going to look at China's CSI 300 index. So this, of course, is sort of the broad-based view of Chinese equities. And with this, let me grab a pointer here. I can show you. We have a downtrend in place, and that downtrend has been in place really since early 2021. For those of you that have heard of the DeMark indicators, those are the numbers floating above and below the price bars. We had this major counter trend signal based on these indicators at the peak, that's that 13 there. And we had a major buy signal down here at the end of 2022. So that was our first indication that perhaps a turnaround was underway. The signals tend to be fairly timely as a counter trend indication. The first relief rally that we received within this downtrend, you can see the downtrend essentially based on this shaded area, which we call the cloud model. It's a great long-term gauge of support and resistance, support meaning an area of buying pressure, resistance an area of selling pressure, and it tells you essentially what the prevailing trend is. So if you look at this as an uptrend, here was your breakdown, still locked in a downtrend based on this model, but you can see what happens going forward, especially out into Q4. That cloud gets very, very thin and would suggest that resistance is more easily surmounted for China's CSI 300. Now, with that first relief rally, we saw a positive divergence in our momentum gauges. So this is the MACD, or moving average convergence divergence indicator. And you'll see that it made a higher low as the index made a lower low. And that positive divergence enhanced what we saw from this counter trend signal, which came from oversold territory. Strong relief rally met resistance, as it often does around the cloud, but notice it's inched into the cloud, and we have some sort of initial support nearby that we think has a good chance of holding and giving a recent oversold upturn on this retracement. So it tees up this benchmark, in our opinion, for a higher low relative to late 2022. Also teed up for a potential breakout or bullish reversal, given the thin nature of that cloud going forward. So we're encouraged by the action in here as potentially indicative of a potential turnaround in the coming months for China. Now, we do something called a relative strength work called this relative rotation graph, or RRG. This is a proprietary way of envisioning sort of normalized relative strength, often on either the country level or on the sector level. And in this case, we've taken the sectors that comprise the CSI 300 and run them against the CSI 300 themselves. So it's a way to look at sort of sector rotation within China. And notice there, if we were to animate this chart, there actually would be a sort of a clockwise rotation to it. You can kind of see that visually. Each of these dots represents 1 week of trading. So we see a 12-week trailing history of where these sectors have been. When you see something pointing up and to the right, that means it's outperformed with growing momentum. Now, when it turns the corner and starts pointing left, well, that means it's not only lost upside momentum in relative terms, but also has started to underperform. So you could imagine, just generally speaking, these are going to be the best place to be from a relative perspective, whereas these are going to be the ones that you'd want to be underweight. So it's not a trading model, but a great visual sense of relative strength. And you can see not only the sectors themselves and their trajectories versus the benchmark, which is represented by the crosshairs, but also how they stand relative to other sectors, just given the normalization here. The sector of focus today is internet. So we had the CSI Overseas China Internet Index thrown in here, and you can see that right over here. And the trajectory is favorable. and really has been now for a few weeks in terms of relative performance. We also have good trajectories in telecom, so communication services, and also technology. So that's this one here. So we want to be where the sectors are pointing up and to the right. And that makes a case not only for internet and technology, sort of in relative terms, but also you can combine it with what we've seen in absolute terms to make a pretty strong case from a technical perspective for a good turnaround here. Here is the KWEB ETF, so the KraneShares CSI China Internet Fund. And we wanted to take a sort of a very big picture view with this monthly bar chart. And you can see a sharp downtrend has now given way to a trading range environment. This is a downtrend that was shared by, broader China benchmarks, as you saw. And the trading range that has ensued has exhibited improved long-term momentum. You can see that in this monthly MACD indicator. When this indicator crosses over, it shows a momentum shift that's meaningful. It had been pointing lower since mid-21 and now is pointing higher. So that's our sort of first indication here on a long-term basis that there's been a meaningful momentum shift within this trading range that's been established. The ETF is neither overbought nor oversold on a long-term basis. If we are going to zoom in here on the weekly bar chart, and you can see that the downtrend again has culminated into this trading range. And for the technicians out there, this has the shape, in my opinion, of an inverse head and shoulders pattern. It's a longer term reversal pattern that would be complete essentially on a breakout above these highs here. But we'd be excited to see KWEB get above this weekly cloud. And you can see it's very, very close to doing so. And the cloud is very, very thin here as well, as it was for the CSI 300. So with just incremental upside follow through, we would expect to see a bullish reversal in KWEB per this weekly cloud. And that would then target secondary resistance, which is in the high 30s. And that's sort of a twofold level that you can see there. Not overbought, not oversold. Stochastics are mostly pointing higher in China. And we've seen intermediate term downside momentum here sort of go from negative during the corrective phase to now neutral. So it seems to be shifting in the right direction as we see continued traction out of US equities and sort of a risk on environment having manifested itself since the S&P 500 broke out in May. So we're encouraged by the action there. This is the KBA ETF. So you can see the title there. And this also is broader China. So you can see here too, we had a corrective phase or retracement phase that was associated with this downside intermediate term momentum. However, that has now generated not only the oversold upturn here, but we have a counter trend indication from the DeMark indicators. It's not quite as strong as what we have for the CSI 300, but something that would suggest that we see a relief rally. And you can see that how that would leave this long-term support for KBA intact. So again, successful test of support potentially, oversold conditions, room to the cloud-based resistance, which gets quite thin a little bit later this year. So very encouraging long-term action in absolute terms. And here too, we have the ratio looking at the KWEB ETF to the S&P 500 Spider ETF, so the broader US equity benchmark. You can see really a very similar setup here in relative terms. So not only do you have this sector relative positioning looking somewhat encouraging when we look at that RRG or relative rotation graph, if we were to take China and throw it against the US, you can see here too, it looks like it's in a bottoming formation. So with this downtrend, so sharp phase of underperformance for China Internet versus the sort of broader US equity market. Down here, October last year, when the market essentially bottomed, we had a sign of downside exhaustion from the DeMark indicators, similar to what we saw back in here. So that gave way to a nice relief rally in relative terms. So that was that kind of initial push higher off the October low. And now with this phase of underperformance that we've seen of late, we have another indication. So very much aligned with what we have here. This is, if you see the 9 circled, this is one of the DeMark indicators. We also have a 9 here in relative terms on the buy side. This was a 9 on the sell side. So we have a sort of a countering indication to what we saw on the sell side towards the start of this year in relative terms. And what that means to us is that we should see rotation into China. When we see rotation into China, it tends to be, either sort of a country related situation, or it just means that we have a more risk on focus tape, meaning emerging markets have gotten more appealing. We have the emerging markets sort of as a long idea in our long idea list. So we are comfortable with that exposure right now. It is, of course, higher risk than anything that's uptrending and has an established sort of positive long-term momentum outlook. But as you can see with the long-term gauges behind the KWEB monthly chart, you can see this is really very promising. So this is considered to be improved. When the MACD gets above 0, that's when it turns positive. And of course, that's going to take a long time at this point. So we want to just make sure to stay on the right side of the longer term momentum gauges in our positioning. So we have those on our side. And then also we want to look for the positive catalysts in the form of these kinds of oversold buy signals that have popped up. And the good thing about the trading ranges that we also have sort of well-defined support and resistance levels. You can see the cloud model is also acting as a very clear or clean gauge of resistance and support. So here's an example. When we last saw a breakout here, successful tests of support and a really very strong up move. The cloud can be really informational as to keeping us again on the right side of the market here. So we're encouraged from a technical perspective by the action in China. It's a market that we know holds risk, but we have the charts to be able to help us to manage that risk, and we can always identify support levels and use those support levels to help us establish stop losses when momentum is not favoring China. But as you've seen in the charts, we do have some real signs of life there from a technical perspective. So here, for those of you that are interested in technical analysis and want to follow our research, feel free to visit our website and sign up for a free trial. And for more information about our TAC ETF, which is US equity centric, uses sector rotation and also asset allocation to manage risk, you can click on this or go to this website here, Fairlead Funds. And thanks for your time today. And obviously I'll be happy to take questions as they arise.
Yeah, that's fantastic, Katie. And yeah, as a shareholder in KWEB and KBA, I'm definitely encouraged by some of the improvement that we're seeing from a technical perspective. We want to shift away from Katie's great work on the technical side to Stephen, who really does some really interesting work analyzing the positioning of actively managed funds. So maybe, Steve, we'll hand things off to you, but love for you to share with the audience a little bit about yourself as well as Copley Fund Research.
Absolutely. Thanks, Brendan. And thanks, Katie. That was a fascinating discussion there. And it does mirror kind of stuff we're seeing on the positioning side as well. I just want to check, Brendan, you can see my slides before I start? You can see the front slide?
Yes, we can.
Excellent stuff. Okay, I'll give you a brief introduction on Copley Fund Research. We, as Brendan said, we analyze the holdings of long-only equity funds. So we take the latest available filings for hundreds of funds. We split them by regional focus. And we look at 6 regions or countries, if you like. So we look at 3 specific country markets. So that's the USA, China, and the UK. And then we have regional funds across Asia, ex-Japan, emerging markets, and global. And then we analyze each individual fund. We aggregate them together to give us insights on positioning across stocks, countries, sectors, industries, all sorts of different ways of slicing that data. So for this analysis, I wanted to focus on emerging market, Asia, ex-Japan, and global funds. And I've just put up the top 25 or so funds within each universe there, just to give you a quick overview and to understand what kind of funds we're looking at here. Some of these names I'm sure will be familiar to all of you. So starting on the left, we look at 86 Asia ex-Japan strategies. That's one of our smaller fund universes. And the funds you're looking at there are the typical names that you'll be familiar with: Schroders Asian Opportunity Funds, Veritas, Matthews, Fidelity, all the big names. The GEM Fund universe is one of our biggest. We look at 380 active strategies. It's a really well-followed market. American New World's funds, that's part of Capital's funds, Invesco, Fidelity again, and GQG Partners. And then on the global side, 350 funds, but a much larger asset pool nearing $1 trillion. So again, some massive funds from Capital, First Eagle, Fundsmith. So I'm sure your audience are aware of many of those strategies, and that's what we do. So we break down the holdings of those individual funds and aggregate together, and we can hopefully bring you some insights on China. Now, we chose obviously these three fund sets because they have reason to invest in China as part of a broader regional strategy. So China forms part of the investment strategy for all these three investor types. And I wanted to start by analyzing the fund weight in China and Hong Kong over the last decade or so, which the left-hand side of this chart shows. And so it's split by color. You can see the average weight, and this is the equally weighted average for all the funds in each fund universe. And you can see, especially within Asia, ex-Japan and GEM funds. So GEM, sorry, is the acronym for Global Emerging Markets. That's a rising trend up until the peak of late 2020, which was the kind of period where tech crackdown hit and peak China occurred. And it kind of mirrored on Katie's charts as well there. So that was the peak weight for the funds. And since then, it's come off fairly aggressively. And you can see among emerging market funds, we're kind of at 26.8, among Asia funds, 39% or so. And global funds is the big outlier. And if you hold a global fund and are expecting any kind of China exposure, you're probably not going to get it. On average, there are a few funds that hold reasonable exposure, but you can see the average weight there is 2.7% of your average global fund. So China doesn't really feature. Global funds are typically much more heavily invested in the US and in Europe again. And so I think that the noticeable thing really is that sell-off and the fact that we're now at around about 5-year to 7-year lows in China among these funds. Okay, and fund managers know that. They're very cognizant that today's allocation in China is at that lower level, and they've been used to holding a higher level in China at most points over the last 5 to 7 years. And we can see this trend almost exacerbated, if you like, within the KWEB portfolio, which the right-hand chart shows. So we've taken the latest portfolio of the KWEB ETF, and we've looked at the average holding weight across all those stocks, again, by fund group. And you'll notice straight away global funds almost not allocated or exposed at all to China Internet, as Brendan alluded to earlier on, with a 66 basis point weight. But Asia, Japan and GEM funds much more well allocated. But again, we're looking at this big sell-off from the peak. And again, so versus their own history, emerging market and Asia, Japan managers are very much under allocated. You know, there's a lot's happened in the last 5 years, plenty of growth in China, which isn't really reflected in the portfolio weights. So I think that's an interesting kind of statistic. And I now want to focus on emerging market funds. Now, for us, these are kind of our core products. It's a big universe, and it's interesting in so much as China is a big weight among emerging market funds, but it's also a universe that has lots of alternatives. So emerging market managers could invest in Brazil, Poland, Saudi Arabia, Indonesia, Vietnam, etc. So to get your China weight correct is key in performing in this market. And so the left-hand chart here shows the net average weight in China and Hong Kong for emerging market funds minus the index weight. And so this obviously tells us whether investors are underweight or overweight China at the moment. And the chart shows us that we are very much underweight and have been pretty much for the last decade or so. But we have come in from the lows. Now, the underweight, the peak underweight we can see here, that coincided with the peak weight in China as well, when maybe China got away with itself a little bit. Active fund managers didn't follow the market higher. And so that underweight got pretty significant at over 5%. The tech crackdown occurred, and obviously prices have come in a lot for some of the larger tech names, and managers have taken the opportunity to reduce some of that underweight now. And we feel like we're in a kind of consolidation phase a little bit here, where managers are kind of comfortable holding an underweight, 1.67% on average now. But it kind of depends where the market goes. And we've kind of given some detail here to give you some granularity on where funds are positioned in China on the right-hand chart. Right? So you can see the histogram of weights shows the bulk of EM managers at between, say, 22 and 32%. But with a long tail to the downside, there's a lot of funds here who are really underallocated in China at the moment. You can see those in that kind of bottom chart here, the smallest weights like AQR, Wasatch, Virtus, Mobius. I know Mobius is a smaller cap strategy, but very low weights in China. And this top right-hand chart here aggregates the average weights in China by fund style. So it doesn't matter what you do in emerging markets. If you're an emerging market yield manager, value growth, aggressive growth, on average, you're all underweight China. Okay, so it's very much a consensus position at the moment. But obviously that carries with it risks. And if China does outperform, and if we do see this kind of consolidation and turning to the upside, then active managers stand to lose money if China outperforms here. So that's the way we're positioned, that the upside, the risk is to the upside among emerging market funds in China. And I think it's important here to split out where the underweight in China is coming from. So you're not ever underweight China as an asset manager. You're underweight a bunch of stocks or a bunch of sectors or whatever. There's no such thing as being underweight China in the active management space. So we can split that underweight by the KWEB securities and the non-KWEB securities. So effectively China's internet and then everything else other than China's internet. And you can see that underweight and the risks are really in the internet space in China. And that's where active managers have found themselves underweight some of those larger companies within the KWEB space. And actually the rest of China is a marginal overweight. So again, it enhances this risk if we see this outperformance and we see this kind of change in sentiment, the risk to the upside, which has the potential to see buying from active managers to close that underweight. If we see a genuine change in sentiment here. And the right-hand chart just gives you some context of where that sits, how big is this KWEB China underweight versus the whole of EM. And you can see China KWEB is the third largest underweight globally in emerging markets at the moment. So outside of Taiwan and Saudi Arabia, which is a recent country addition in the MSCI Emerging Market Index, with active managers positioned much more bullishly in Latin America, Indonesia, and some non-benchmark stocks in the USA and the UK who have exposure to emerging markets. So that's the kind of setup here. So it's certainly got the potential if we see this sentiment change. And that's where I feel we are at the moment is if we kind of summarize, there's no doubt that China is at its kind of lows amongst the active community at the moment. We're definitely coming from the highs. We're where we were 5 to 7 years ago. And that'll be on the minds of investors. And in addition to that, the majority of managers are positioned underweight China. So they're not positioned for outperformance. And specifically, they're not positioned for the outperformance of the internet sector in China. So again, if these fundamental aspects play out in the technical aspects, then active managers will underperform, which we expect will more than likely lead to some buying from the active managers to stop that underperformance. And I think that's where we'll kind of leave it from me, Brendan, and the audience. Thank you very much. And if I can ask you all to take a brief look at our website, we run a bi-weekly chart pack, which looks at positioning globally across emerging markets, China, UK, US. That is totally free. We'd love you to join that mailing list. Yeah, the details are there. Thanks very much.
And certainly, another way to follow, Stephen and Copley's great work is on how we originally found you, Stephen, which was on LinkedIn. And once you see some of the great work that Stephen actually provides for free, I think like ourselves, you'll want to dive in even further. And so just great work from Stephen. And yeah, for ourselves, we're big believers in your work and big supporters. Just along with Katie's work, I think we wanted from the KraneShares side, we wanted to articulate a little bit of what we're seeing, from Katie spoke to some of this oversold type of conditioning, the sell down that we've seen from a technical perspective. Stephen, articulated really well this significant underweight within active managers. And the first slide we want to talk about is a little bit of what's led to this technical position as well as this fund positioning. And what we've seen is a shift in terms of engaging with our investors, what their concerns were. And if we were hosting this a year ago, we'd be talking about China's internet regulation, the potential delisting of US listed China ADRs due to the Holding Foreign Companies Accountable Act. Up until the latter part of last year, China was adhering to its zero COVID policy. Western media had warned us that Evergrande was China's Lehman moment, that these distressed real estate developers were going to set off a financial crisis, as well as the deterioration of U.S. and China diplomatic relationships, as evidenced by a lack of travel and communication from diplomats from the two countries with one another. And if we fast forward to today, we've seen a very significant improvement on 4 out of 5 of these issues, where China's internet regulatory cycle has clearly concluded. In mid-December, the Public Company Accounting Oversight Board, the PCOB, after visiting Hong Kong, was able to garner full access to the audit reports of from the big 4 U.S. accounting firms that audit the vast majority, virtually all of the U.S. listed China ADRs, which greatly reduces the ADR delisting risk. Obviously, China came out of its zero COVID policy. We've seen significant support of distressed real estate developers. Today, four real estate companies in mainland China are being allowed to issue stock in order to bolster their balance sheets, though aggregate real estate prices have been very, very tepid. And certainly we're seeing some slight improvements on the U.S.-China diplomatic relationship. Now, one of the factors that has also weighed on the space, highlight on the last slide, on the next slide, which is that many of us saw the rapid KWEB actually rebounded almost 100% from its lows at the end of October due to the removal of China's zero COVID policy. And then we had a little bit of a tempering of pullback in KWEB and China equities due to this economic rebound in China is happening very incrementally. Consumer confidence is growing, but it's happening on a slow pace. And I think that's led to some investors to take some very quick profits on the space, though. To Katie's point, we think that this long-term bottom was reached back in October, and we do see some support occurring even overnight in the KBA stocks, the mainland China stocks. You had the Shanghai Composite is sitting just below the 3,200 level. The Shenzhen Composite closed above the 2,000 level. So we think we're seeing some technical support that Katie spoke to. We're actually seeing it in some of these other indices, but specifically the KWEB, we do think there's a very interesting opportunity. And one of the things that didn't get a lot of publicity that maybe weighed on investor sentiment, weighed on the space a little bit, was that many people would say, well, you had this deterioration around the balloon incident, but in fact, the dollar started getting very strong in mid to late January. And we think as investors started taking the Fed's interest rate hiking more seriously, it put a pressure on many risk assets, including Chinese equities, including KWEB. And it's our belief that as we near the end of the Fed tightening cycle, the potential for a dollar weakening could help provide a catalyst for non-US equities in general, but very specifically to Chinese equities, which we think will be a tailwind for KWEB. So again, a lot of people saw the tempering of this pullback. Many people thought it was driven more by the political narrative, but we actually believe that a contributor was actually the strong dollar. Now on this last remaining issue has been the U.S.-China political relationship. And we know that relationships during COVID, they either got stronger, that there were many COVID babies, but unfortunately, many relationships actually deteriorated. You had the proverbial COVID divorces. And that was really the U.S.-China relationship. We believe did deteriorate due to a lack of travel, a lack of communication between Washington, D.C. and Beijing, and vice versa. We're seeing an improvement there. Now, obviously, you had Secretary of State Blinken visit China just over a week ago. That's led to, there's a lot of talk about U.S. Treasury Secretary Janet Yellen is going to potentially visit China next month. We don't have the specific date yet. But that, I think it's important to recognize that this was preceded by a whole host of U.S. as well as global executives visiting China. Now, business people wanted to get back to China much sooner than the diplomats because they're doing great business there. That while the politicians may have had a harder time communicating with one another, a lot of politicians from both sides weren't traveling. Executives know the importance of the U.S.-China economic relationship as well as for their specific companies. So was it any surprise that Elon Musk, with almost 25% of their revenue coming from China, visited China? Was it surprising that JP Morgan's well-respected CEO Jamie Dimon was in China based on the great business JP Morgan is doing in terms of institutional trading and research, as well as their asset management unit in China? Was it any surprise that he was willing to get on an airplane? Of course not. Of course not. No different than Tim Cook of Apple, just based on the very significant revenue. But we could list many companies. ExxonMobil building a $10 billion petrochemical plant in China. Many executives were just in China. Bill Gates was in China more recently as part of his foundation's efforts. But again, I think what's key here is that if you don't get on airplanes, if you're not breaking bread, having lunch and coffee and meeting with your counterparts, relationships are going to, and the U.S. and China diplomatically are only just beginning that process, which we think will pave the way for more. The key here is Blinken, Yellen. In November, you'll have the APEC summit in San Francisco. We don't know if President Xi will be joining, but we believe if this dialogue occurs, it could pave the path for a President Biden, President Xi meeting in San Francisco this fall. So again, we see these proverbial green shoots in the U.S.-China political relationship taking place. And we think that's key just from an investment perspective. On the next slide, that going into this year, we were very constructive on China on both an absolute and relative basis. And we still believe that this thesis about low inflation in China, strong M2, strong money supply growth, easing interest rates in China, low valuations would provide a constructive year for 2023 for Chinese equities. We maintain that belief that the second half of this year will continue to see policy support, continued easing in China, and simply on a relative basis, that's very, very different than what you're seeing in many developed markets like the United States and Europe, which face potentially higher interest rates, quantitative tightening against elevated valuation. So again, we're big believers in the space. Now specifically, on the next slide for KWEB specifically, we do believe that these factors that are showing up in Katie's charts, that are showing up in Steve's fund positioning analysis, were showing up in the KWEB companies. The KWEB companies did come down, and yet their revenue due to COVID restrictions did not see significant declines. Just that rate of growth did flatline. And what we believe is happening is as consumer confidence comes back in China, as people are able to get out and about within China, domestic consumption will rise, very much driven by policy support that that China will face its manufacturing sector a bit of a headwind due to the global economy slowing. Certainly, we're not seeing significant infrastructure support. So we do believe that an area where policymakers can affect change is domestic consumption. And certainly the KWEB companies represent the transmission engines of domestic consumption as it occurs in line. And so we think KWEB is very well positioned now. And we're not the only ones that think KWEB is cheap. On the next slide, the companies themselves, that Alibaba is simply telling investors that they believe that the company is so cheap that they're willing to break the company up, that many research sell-side analysts have a price target on Alibaba twice where the stock trades today. And what the company is doing by breaking itself up, and a lot of these management teams will be firmly in place starting in early September, where there's a lot of chatter about Alibaba spinning out their Fresh Hippo, their supermarket chain, that this can happen by the end of this year. Certainly these management teams will be firmly in place by the beginning of early September. And really what they're saying to investors is, our stock is so cheap that we're going to force you to value it based on the sum of the parts. And that's something we're seeing recently mimicked by JD.com, which talked about spinning off its property company. You're also seeing significant stock buybacks from Alibaba, Tencent, Baidu, JD. Many of the companies within KWEB are actually buying back their stock. Why? Well, simply, they see what we see on the next slide, which is on a historical basis. KWEB is just so cheap. And again, we think that starting, you're going to see something we're seeing is that, Q4 was, and the beginning of 2023 was really the bottom, that as they left zero COVID, a lot of people in China got COVID, which meant that starting in December and January, you had, unfortunately, a lot of people calling in sick. And that was really the trough in terms of domestic consumption in China. And you saw, in the Q1, in the Q4 earnings calls in February, the management team spoke to, we're seeing activity picking up. We saw that in the Q1 where they said, already Q1's better than Q4, and we anticipate Q2 will be better than Q1. Certainly we had the 618 sales festival. We think that data was strong. We saw the Labor Day travel was very strong. The Dragon Festival travel data, not as long as as the Labor Day, so some of the comparisons are misguided to compare the two. But we see a pickup in this travel, in this domestic consumption story, and we think this very much dramatic undervaluation should hopefully rectify itself. Now that's on just relative to the historical average. On a relative basis, to say U.S. internet stocks, this is simply become a very dramatic comparison on the next slide. That it's hard to imagine, to believe. Now, certainly we've had this AI frenzy, but it's almost hard to imagine that U.S. internet companies are being valued almost twice the level. But again, I think something that we're seeing, that Katie's charts are picking up, and Stephen's great work, fund positioning, is showing this under allocation, and we think this positioning, which some have speculated is back down to October 2022 levels, makes it ripe for a rally. And we certainly believe that we're going to see further policy support, earnings in August. But we think just on a not only absolute historical basis, but certainly on a relative basis, these stocks look very, very inexpensive relative to their U.S. counterparts. And that's made some very interesting comparisons on the next slide. a researcher we followed for and many we've gotten I've known for many years. Jared Dillon, runs a research firm. He sometimes will talk about it. He calls it the market cap comparison, and doing some and preparing a recent research piece will get published hopefully in the next week or so. I kind of stumbled upon this, which reminded me of Jared's market cap comparison game, but I couldn't believe that. Would you believe that all of the companies in KWEB, the aggregate market cap of those companies is now less than both is smaller than Alphabet and Amazon? Certainly what's interesting is that's despite the aggregate revenue of the companies in KWEB is actually larger than both companies. And certainly from a profitability, KWEB, just the companies in KWEB are significantly produce more net income than Amazon alone. Alphabet, a very high margin business, is very profitable, but it's just hard to imagine that investors globally have valued these two companies more than all of the companies. So if you took all of the revenue, all of the market cap of, say, Amazon, you could buy all of the companies in KWEB. I mean, just a simply incredible situation. And on the next slide, just so you can visually understand this, that you could buy all of the companies in KWEB using, this is the cash on the books in the companies in KWEB versus the cash that Amazon and Alphabet have on their books. So the companies in aggregate in KWEB have more than 100 billion in cash, which is twice as much as Amazon, 4 times as much as Alphabet. I mean, that's just the level of how disconnected the fundamentals have become. And certainly, again, both Katie's and Stephen's works only readers. Now, just to kind of take this even a step further on the next slide, that for the market cap of Amazon, you could buy all of the companies in KWEB and you'd still have 100 billion of cash left over. In the case of Alphabet, you could buy all of the companies in KWEB using Alphabet's market cap, and you'd have 400 billion. I mean, what would you rather have? Would you rather have Amazon or KWEB and 100 billion? Would you rather have Alphabet or all of the companies in KWEB and 400 billion? I mean, I just think it just shows that an element of this political rhetoric, many of these historical issues have kept pushed investors, as well as this under allocation, this overweight to U.S. equities. I think that's a global phenomenon, and we simply believe that on the next slide that we have nothing against U.S. equities. We just simply believe that this FOMO, this AI-driven enthusiasm, provides an opportunity to potentially take some profits out of what we believe is expensive U.S. tech and put it into inexpensive China tech via KWEB. Certainly on the next slide, while KWEB represents offshore China, KBA and KA50 represent onshore China. It's more reflective of what investors in China. We do think that as consumer confidence increases, animal spirits amongst Chinese investors will grow. And we've got some compliance slides. But the situation today reminds me back in the summer of 2015. I was visiting some good friends of our firm up in Buffalo, New York, and we were talking about the opportunity set that we saw in KWEB back in the late summer of 2015, and what in hindsight turned out to be the bottom of Chinese equities. And in hindsight, I was accused by these friends of mine after the fact that I didn't pound the table and say why we believe this was an opportunity. And we're not missing this chance. We can't predict the future. We don't know definitively what can happen today or tomorrow, but we do believe that Katie's work on the technical side shows that a potential bottom has been placed. We believe that Stephen's work shows this under allocation to China, and just to his point that the managers coming back into these names, that's the potential dry powder that could drive these names higher. And lastly, our fundamental work just shows we believe what is just simply a ridiculous situation, just this market cap comparison of, say, you could buy all of the companies in KWEB with Amazon's market cap and still have $100 billion. And you'd actually increase your revenue, you'd increase your net income by doing so. We just simply felt like this is a pound the table opportunity. There is a big caveat, again, big asterisk, which is we can't predict the future. We don't know exactly what's going to happen, but we do believe that there is an opportunity here. And we're just so happy to have both Katie and Stephen with us. We want to open things up to some questions. Again, if you're joining us via the live stream on the website, just simply email us at info@KraneShares. And then if you're joining us via the Zoom, you can just use the Q&A button. So let's dive right in. One thing that I thought was interesting, Stephen, is that a lot of what your positioning showed is relative to the benchmark. And for MSCI emerging in MSCI all country world, this global, China's only a 3% allocation, and your work showed that basically these managers hold nothing in China. For Asia ex Japan, China's about a third of the benchmark. And in the case of MSCI emerging markets, China's as of the end of May was about 29%. But I'm shocked because that you showed that many of these managers have so little of the KWEB companies, though Tencent and Alibaba in particular are big Meituan are all top 10 holdings. So it's interesting to me that on a relative and absolute basis, these managers are taking big bets. But I'm just kind of curious your thoughts there. But also, I couldn't help but notice on that same slide, and we'll make these decks available. Katie and Stephen have generously allowed us to share the decks. But you showed that United States stocks, UK stocks, Japan stocks are showing up in EM funds. I mean, I didn't realize the United States was part of emerging markets or Japan. I mean, just kind of, just out of an observation, you're seeing these managers go way out of benchmark, and I just find that very interesting.
Yeah, I'll answer both of those. So you're right in terms of there's a big distinction between global and emerging. It's more than probably most people think, in that the global funds are dominated by the US. It's well over half of the average global fund. And as I say, then mainline Europe, and then it's Asia. Asia's tagged on, and China's an extremely small part of that. But for EM and Asia ex Japan investors, it is a massive slice. And although there's kind of a difference in underweights when you look at individual stocks. There are stocks that are avoided, and so nobody holds them, so they are by default an underweight. And then some of the Chinese banks, for example, fit that category. And then there are stocks like Tencent and Alibaba that lots of people own. They just don't own them in the size that the benchmark does, right? So 3/4 of EM managers own Tencent and Alibaba, right? And Alibaba in particular has seen ownership levels really rise over this past 6 months or so, as Meituan as well, like you mentioned there. It's one of the massive jumps in ownership we're seeing. And interestingly, it's coming from value managers. Now, if you saw my slide earlier, yield and value managers are the biggest allocators in China at the moment. So typically people associate EM and China with the high growth, aggressive growth. It's the value funds that are coming in at this moment in time because, as you mentioned, it's simply cheap. And so, this isn't me trying to sell the situation. This is what's happening. So emerging market value funds that typically hunt for cheap stocks are buying into China, and specifically stuff like Alibaba when it's trading at $86. I know that there's been repeated attempts for Alibaba to break 100 again, and it keeps coming back down again. At some point, that'll go, and you can see people preparing for that in the active community. So that's I think that's worth noting, is that people don't dislike Tencent and Alibaba. They're just at the moment not holding as much as they could hold in Tencent and Alibaba. And I think it's the overall, and it's not just two stocks that form the underweight, it's many different stocks. It's a big combination of, China financials are held underweight fairly severely. Other state-run stuff people don't like so much and things like that. But we definitely feel that we're in this, it's kind of an interesting phase, I think, where I think one of your questions there asked about India. I saw it pop up there. In India, we're just writing about at the moment, is a market where managers are moving to underweight. It was the most popular market for the last decade with Modi coming to power. That switched. So you've got this there's quite a lot of moving parts at the moment, with Russia obviously been removed from the financial markets last year. You've got a lot going on. And EM managers are adding to their Saudi Arabia positions. They're removing a little bit of India. And I think China's sitting tight at the moment. I feel like China's got a good chance of going higher as we consolidate these kind of levels. And as you mentioned, it is definitely cheap, and it's reflecting in that way. And so you can see out of benchmark stuff is definitely an area where managers try to capitalize on. And it's typically in developed market stocks that have an income stream of sorts to emerging markets. So in the UK, kind of British American Tobacco, Anglo-American, names like that, emerging market managers do hold. They have an income stream in EM. Japan, we just wrote about a lot of the high growth funds are buying into some of those stocks. The US, who is it, EPAM System, Samsonite, names like that are listed in the US that have an EM stream. But yeah, they are certainly out of benchmark, and they do provide, I guess, an element of differentiated returns from the index if you're trying to get some kind of differentiated performance. So yeah, there's that side of the coin as well. I don't think that's necessarily a bad thing, but it does mean that managers are straying from benchmark to a degree.
I think it's that part, it's very fascinating, this kind of going so far out of benchmark. Historically, you see people buy AIA insurance and the Hong Kong Stock Exchange. But this is very, very different. I guess that dry powder, that's kind of, Katie, where I think you could, does that, this, some of Stephen's work shows this, that these managers continue to pivot back in, that buying, I think comes back, that kind of gets reflected in the charts. Oh, you're just on mute, sorry.
There you go. So with any kind of bottoming process, and emphasis there is on process, right? Where you tend to see that sort of initial surge off a low, and often that low is associated with positive divergences in momentum, meaning that last downdraft occurred on less downside momentum. That first relief rally is usually quite violent to the upside. And then the retests, as we've seen, can be equally violent in a way. But it does, allow for accumulation. And it seems like that's what we're starting to see inklings of. And by the way, it's very top down in its orientation. It's not, specific to Tencent or Alibaba, or even China, quite frankly. I mean, look at, the high growth technology or innovation focused ETFs in the US. They have very similar setups where they peaked in early 21, downtrended, have entered these kind of trading ranges characterized by one, maybe two retests of support. So they really have sort of this homogeneous technical setup. So we're expecting at the same time that we get rotation into China, also rotation into some of these small and mid-cap tech names in the US that are positively correlated to China. So to us, it's almost like, not even just about China and its economy and prospects that you cite, Brendan, but also because of risk appetite and sort of a willingness to seek value in different areas when folks have enough confidence in the equity market more broadly or the economy more broadly. And we have seen market sentiment, which we can gauge a number of ways. We can gauge it through the volatility index. We can gauge it through investor polls. We can also gauge it through, market internals data like advancers and decliners and certain ratios, looking at gold, et cetera. All of it shows that there is some bullishness out there. It doesn't mean it will be there for the next few years necessarily. In fact, we kind of suspect that global equity markets might be in sort of a bigger, wide range for a few years, which will be something we have to navigate. But within that context, you're seeing bullishness, and the bullishness, whether you think it's founded or not, it's certainly there, right, in our measures. So for now, it's contributed to momentum in the US that I think ultimately carries over to these lagging areas of the global marketplace.
A little bit like a potential reversion to the mean.
Mm-hmm.
Yeah, I guess, do you have a kind of particular view on US equities where I kind of feel like, US stocks are, not quite 2/3 of the global market cap? It seems like feels like a very high number, and the potential, just taking profits or some element, to kind of fund some of these laggards seems, but do you have a particular view on the US market, Katie?
Yeah, and we do, of course. I mean, the S&P 500 with its breakout in May yielded a target above 4,500. It's not that much upside from here after what we've already seen, but it's still upside. And it's not necessarily a stopping point. It's just a price objective that we can arrive at from our methodology. So we do have upward prospects based on the breakouts that have occurred. But I think the most significant development and change really over the past 2 months has been improved market breadth or participation. And that's not just in the US, but globally. And you can see that in things like the cumulative advanced decline line, which has turned the corner in our opinion. So we're seeing the breadth improve. And it doesn't necessarily mean the mega cap stocks are going to suffer. But it probably means they won't be such an impressive source of upside leadership as they were for the first few months of this year. As everyone knows, the sort of top 7 or so stocks accounted for pretty much all of the gains in the S&P 500 for the first few months of the year. So that type of environment, which is challenging in its own right, is probably not upon us. So, you can still maybe buy Apple and feel comfortable with that. The trend is there. It has momentum for now. But also you can have more opportunity elsewhere. And that's what we're sort of enjoying over the past few weeks, is that improved market breadth in the US that makes for really kind of an easier tape to take advantage of outside of those mega caps. So we're not really active sellers of the mega caps, but we're active buyers elsewhere. We're more interested in stocks that have broken out. As an example, we highlighted transports. So the transportation average in the US has a nice short-term breakout to take advantage of. So you'll see that also in the relative strength ratios. So we looked at KWEB versus US. You saw some signs of bottoming there longer term. And those signs are shared by sort of the higher growth realm here in the US too.
Yeah, I certainly, it was interesting, this idea of opening the proverbial kimono on our research partners was originally driven by some great work from our friends over at GavCal Research. And it was interesting. They recently showed how they looked at the 10 largest stocks at the end of every decade over the last 40 years. And it was kind of remarkable. In 1980, it was a lot of energy and value type of companies. In 1990, it was all Japanese companies. In 1999, it was all US tech. In 2010, it was a lot of non-US Chinese companies. And then today it's US tech again. And it's funny just how mentally we take the last decade and say that's going to be the next decade. And be curious, Stephen and Katie, how do you think about when you engage your end clients and investors? Do you get pushback where people seem kind of married to what worked in the past? versus what could potentially change, leadership change in the future?
What I would say to that, Brendan, briefly, and I'll be curious what Steve says, but would just be that the most questions I'm getting right now are about energy, the energy sector. So as a testament to, people getting married to a space, energy was the best performer over the past 2 years by a long shot, right? And so naturally people have overweight exposure because of that outperformance. Our own ETF recently kicked out energy because there's been a pretty meaningful loss of long-term upside momentum. And so we want to, avoid those bigger downdrafts that energy potentially has in store. So our recommendation now is to sell oversold bounces in energy stocks, to those who are asking about it. So I think we can trust that there will always be that kind of cyclicality to the market. So we like to focus on the sectors, but I'm quite sure it's something that can translate, to the other areas of the markets. That relative rotation graph that I showed you with the sectors versus the CSI 300, it's really remarkable because you can apply that to kind of anything and visually see that cyclicality, which is pretty cool. I mean, we could take even, say the semiconductor sector and look at the individual stocks within and see their cyclicality. So you can really visualize it. Just given that cyclicality, you can trust that there will be rotation and mean reversion.
Yeah, Brendan, just to add from my side, I think, as I mentioned earlier, I mean, the emerging markets are just so ridiculously dynamic at the moment with everything that's going on. If you look at what the EM index was 10, 15 years ago, you'd barely recognize it. I mean, it's totally changed. Even really since the Jack Ma kind of speech, which kicked everything off in late 2020, things have changed, and they've changed a lot. And so you are seeing this big switch in investor appetite for certain areas of the market, things move in and out of favor. And as I say, at the moment, a lot of assets going the direction of ASEAN. So the kind of Indonesia and Thailand, which were fairly beaten up after COVID. And then, people moved to India a little bit because it was perceived as a bit of a safe haven. And now we're seeing a lot of assets moving to MENA and Saudi Arabia and Qatar and areas like that, kind of on the back of the energy trade, but that is persisting. And LATAM is the big overweight, and these things do move, and nothing stays the same for long. I think that's the thing. It very rarely, you're not static in EM at all. And so it'll be interesting to see what happens to the internet space in China. That was the space. I mean, it accounted for whatever it was, nearly 50% of the EM index at one point. China, and now it's back down to wherever it is, high 20s. Whether we get back up there again, and we're definitely seeing signs of it. As I mentioned, individual stocks. We looked at Sands China, kind of consumer play in China. That's starting to see buying from long only funds again. So it's big out of favor stock over the long term. People are starting to engage with the name again. We did see a lot of engagement in the energy sector, but that seemed to have been a little bit of a kind of dead cat bounce from the ownership perspective, where it was a massive underweight. Obviously, oil peaked, people bought in, and now, along with yourself, Katie, appear to have stopped buying. But no, I think in summary, Brendan, it's a hugely dynamic world, and I think I doubt very much that China will fail to play a part in it.
Yeah. Well, and certainly that dynamic nature, the changes is what obviously is job security, for, the continued update of your work with Katie and Stephen. And, certainly we're so appreciative of the time you've dedicated out of your busy days to join us today and provide these great insights for our clients. And, we certainly encourage all of our viewers to please delve further into Katie and Stephen's work, that we're big believers, big fans of their work. And certainly, again, just wanted to say thank you, and certainly, very much appreciate both your insights. And again, for those who'd like to see the presentation or have a follow-up question, we had a few questions about just the U.S. presidential election and a few other. But please email us at info@KraneShares.com for the presentation, or if you have a follow-up question or would like the contact details for either Stephen and/or Katie. So thank you again, and certainly thank you both.
Thanks ever so much, Brendan. Thank you.
Take care.